Good morning, everybody. It's October 27th. It's 11 a.m. in Long Island, and it's a great day. We've just had a string of one beautiful sunny day after another. For a while there, it felt like summer, but now it feels like fall again. So we're happy with the weather, and we're very fortunate to have Max visit with us. Max, as you can see right behind me, looks more laid back than ever. And I guess for all the anxiety out there about the stock market's volatility and concerns about it being elevated, maybe too high, too close to the sun, the market just keeps making new highs here. And so the market seems to be about as relaxed about making new highs as Max seems to be about taking naps during our conference calls. Anyways, let's get right to it. Because of the Fed not listening to us, because they are going to apparently cut the Fed funds rate by 25 basis points on Wednesday, and then if they do that, the odds are pretty high that they'll cut again in December. What we're doing is lowering our odds of our base case scenario and increasing the odds of a meltup. So the base case scenario had been that we get, and it still is, the base case scenario is that the economy is resilient, it's growing, inflation's kind of stuck at 3%, but not for long, it's going to come down. The base case doesn't really depend much on whether the Fed lowers interest rates or not. We prefer that they don't, because that increases the odds of a melt-up. But the base case had been 55%. Now we're lowering it to 50%. And the melt-up scenario, which is we get to 7,000, that is our year-end target, and our 7,700 target, that is the year-end for next year. We get there a lot faster, and to levels that maybe show a forward PE going up from 22, 23 to maybe 25, 26. Valuation gets even more elevated. And so the melt-up scenario goes from 25% to 30%. So 50% base case now. Melt-up is 30%. And that leaves us unchanged with our 20% scenario, which is a bearish one. It's either a significant pullback or an outright correction of 10 to 20% or an outright bear market. And I guess the economic background would be that we would have some real concerns about a recession again, and a recession might actually happen. So, we try to be reasonable about all these things and have assess not only what we think is most likely, but also give you some indication of what could go wrong and give you some probabilities on that. So that's it. That's kind of what's changed in our thinking. And it's mostly because the CPI inflation rate on Friday was widely interpreted to be cooler than expected. I expected 3% on a year-over-year basis. That's what we got. We got it both in the headline and in the core rate, but the markets want to believe that's a cool rate. That's fine. And that markets therefore are convinced that we're going to get these two rate cuts before the end of the year. That obviously increases the chances of a melt-up, as I just mentioned. So the Fed seems to be very concerned about the labor market. Clearly, we don't have much data. We don't have much any data coming out of the government. All the data we have is from private surveys to a large extent. The Fed is also open for business, so we're getting some Fed data. What we know is the retail sales weekly report still looks quite good. We know we've been following the forward earnings projections of analysts. We know that S&P 500 forward earnings is at an all-time record high. That correlates pretty well with the index of coincident economic indicators. So before the shutdown, we knew that real GDP increased by over 3.5%, almost 4% in the second quarter. And we know that the Atlanta Fed was tracking the real GDP growth also at over 3.5% for the third quarter. Uh, Fourth quarter is going to be kind of a mess because of the government shutdown, but the consumer looks like they're hanging in there from the retail sales report. What else do we know? We know capital spending is probably isn't likely to be slowing down much, given that the hyperscalers are spending so much on expanding capacity. So put it all together, the economy is doing pretty well. But the Fed is concerned about the labor market. We had downward revisions in the last 3 months through August is the data we had. Virtually no growth. Governor Waller kind of tipped us all off that the Fed's been getting weekly reports from ADP. I guess as this has been known in some circles, I wasn't aware of it. But the Fed's been getting weekly reports from ADP on what their data is showing for the labor market. And Waller indicated that it's showing that there's not much, if any, growth in in employment or in the labor force for that matter. And so the Fed is focusing on the fact that what they believe is a fact that a 4% Fed funds rate is restrictive. They believe that the neutral rate is 3%, so that if they lower it by a quarter point now, this week, if they lower it by another quarter point, by the end of the year, that would get them down to 3.5%, which from their perspective is still restrictive enough, in their opinions, to bring inflation down to 2%. Let's look at all that in charts. But before I do, let me just give you my conclusion again. The economy looks fine. Consumer looks like they're continuing to spend. Capital spending looks strong. We still have a very large federal deficit, which is a net stimulus. That federal deficit is being bolstered, it's being ballooned by interest payments. Those interest payments are stimulative. They're called net outlays. They are governments spending on interest that individual investors collect and can spend. Institutional investors can collect and spend on buying more stock. And so there's the economy, I think, is fine. The labor market is suffering from some issues that I don't think can be fixed with lower interest rates. So if that's the case, well, let me tell you what those issues are. Again, we've talked about it, and that is the labor supply is being hit by the issue of the freezing of the immigration, illegal immigration. I'm not sure what's going on with legal immigration, but some of the visa issues might be slowing that down. Deportations are obviously underway, creating a lot of tension in some cities, but the deportations continue. And again, there's not much that the Fed can do about the labor supply. Baby boomers, I may be the last baby boomer working, but I have no intention of retiring. But my friends are retiring, and baby boomers are retiring, very, very experienced. They've worked for a long time. Many of them may be into their early 70s, but they are retiring now, and it's hard to replace them with young, inexperienced workers. And speaking of young, inexperienced workers, on the demand side, it seems like a lot of companies have decided that it's time to spend some money. Let me turn this off. I'm almost there. Sorry about that. It's just so okay. So the labor market on the demand side, I think a lot of companies are spending money on at least assessing the extent to which AI might be useful to reducing their headcount, or at least they've decided not to increase their headcount while they're assessing whether AI can make a difference to the payroll to the headcount they need and to the productivity that they obviously would like to achieve with AI. We at the Ardenia Research are spending a fair amount of time trying to assess how to incorporate it into what we're doing, and we're seeing some real possibilities in how we might use it to increase our productivity and make our service more valuable to you. So we're kind of, the more we look into it, the more we see where the problems are, but the more we see that there are solutions to those problems, and that AI might actually be a productivity enhancer for us. So we're kind of excited about it, and we'll keep you posted on how that's all going, because I think everybody, Max just got up for some reason. I don't know what he heard. I guess he got excited by AI. Nope, not so. He's back. All right, so the Fed can't do much with lower interest rates about all that. The theory of lowering interest rates, of course, is a simple, economics 101 idea, in that you lower interest rates, you boost demand in the economy. The demand for goods and services increases. Well, the problem is demand is already quite strong, as we can see with the growth rate in GDP. And it's not clear that it can get much stronger by lowering interest rates. And if you can't do much with lower interest rates to increase employment, then where does all that stimulus and liquidity go? How about asset inflation? It may not go into consumer goods inflation, but it might go into asset inflation. And that increases the odds of a melt-up, which is what I started my conversation with at the beginning of the show here. So speaking of shows, let me show you some charts here that might be relevant to our discussion. And Max, go back to sleep. Okay. So here we go. Let's start out. Let's start out with this, and then I want to show you some charts from the quick take. So this is today's date for the charts. The morning briefing was titled "Inflation 3% is the new 3% is the new 2%." The Fed seems to have concluded that they can live with 3% for now because they are projecting that inflation will get down to 2%. And meanwhile, they want to lower interest rates because they are projecting that if they don't do that, the unemployment rate might go up, and that's a concern for them. So meanwhile, the data that we do have, this came out on Friday, showing the Purchasing Managers Index for the United States, S&P Global data. This is the flash data, and as you can see, the flash data for the non-manufacturing for services has actually gone up. The flash for manufacturing is here. This manufacturing has been more bullish on manufacturing than what we've been getting from the ISM. The ISM, frankly, the ISM, particularly manufacturing survey, just seems to be too pessimistic relative to what the economy has been doing. The economy has been stronger. GDP has been outpacing. If you look at, for example, GDP of goods and compare it to the ISM manufacturing, they used to track pretty closely. The monthly ISM used to be a good indicator of GDP, not so much over the past couple of years. This is commercial bank loans, comes out every single week. As you can see, we're starting to see more growth in commercial bank loans. I think that's a sign of life out there, of economic growth. This is one of our favorite homegrown charts. What's homegrown about it is we take forward earnings of the S&P 500. We have the data both monthly and weekly, so we're obviously tracking the weekly. And the weekly is at an all-time record high. The pace of increase seems to be improving, and it's got a pretty good correlation with the index of coincident economic indicators, which is actually a pretty good indicator of real GDP. The CEI looks like it's kind of flattened out here. The latest data we have for it is August, as you can see. They can't, the conference board can't do this calculation because they don't have the data like payroll employment that they need to calculate it. So we don't have any update on that, but we can do fine, I think, with our handy dandy forward earnings number. Now, figure 6 shows what Fed Chair Powell has pointed out, and that is the labor market's doing some kind of odd things here. What we're seeing is that the unemployment rate remains very low at 4.3%, but the reason it's there is because the labor supply has kind of edged down, or it's been flattening out, and at the same time the demand for labor has kind of been declining, but in an equal way. So we have the labor demand equals labor supply, but at a 4.3% unemployment rate, which I think is pretty close to full employment. But they're freaking out that it might go up to 4.5% if they don't lower interest rates. And I'll show you what that's all about. So here we have the unemployment rate. You remember the Fed freaked out about the labor market last year. Remember the SOM rule? Everybody got excited that if the SOM rule could trigger a big, massive increase in the unemployment rate. And I pointed out, well, the SOM rule and other rules may be irrelevant here because the reason unemployment rates usually go up is because Fed tightening leads to a financial crisis, leads to a credit crunch, leads to a recession. And I kept pointing out that this time around, yeah, we had a little mini financial crisis in 2023, but we didn't have a credit crunch, so we didn't have a recession, and so the unemployment rate doesn't have to spike up. But it has turned up somewhat because the demand for labor, maybe from AI-related issues, is starting to affect the demand for workers. And we're seeing that in rising unemployment rates for teenagers and rising unemployment rates for kids coming out of college. So I think there's some evidence here that the initial impact of technology is to create a problem for job seekers who are relatively young. Experienced workers are having no problems. By the way, AI needs experienced workers because AI makes mistakes, and you need experienced workers that can check AI to make sure that the ultimate product is correct. So here's another story on the labor market. A lot of talk about this is the no hire, no fire labor market. That's not exactly accurate. In August, we had 5.1 million people that were hired, and separations were 5.1 million. Usually, the hirings somewhat exceed the separations. Separations are quits and layoffs. And so clearly, if you have fewer quits and layoffs, you're going to have fewer hirings because you don't have to replace as many people. But what's really changed in the labor market of late is we're not getting employment gains. By the way, if you took, and we've done this and shown it to you, if you took hires and subtract out separations, you get something that's pretty close to the payroll data that comes out, the change in payrolls that comes out every single month, not surprisingly. So, but again, the government's not producing this data either, so we can't even come up with an estimate of what's going on with the labor market in that regard. So the Fed thinks that the unemployment rate is going to go up to 4.5%. So they've got to lower interest rates, and they think they'll get the unemployment rate back down to 4.4% next year, then 4.3% in 2 years. And they think that the long run unemployment rate is 4.2%. So I guess the question is, do they really have to lower interest rates? Will that really keep the unemployment rate from going up? But will the unemployment rate even go up? It might not if we have this situation where we're in equilibrium between supply and demand. But right now, the unemployment rate is 4.3%. That's the reality. And they think the long run unemployment is 4.2%. So what's all the rush to lower the Fed funds rate? Meanwhile, the inflation rate, so the dual mandate, they're like 0.1 percentage points away from full employment. At least that's where we were in August. Now they're kind of guessing where we are. Meanwhile, the inflation rate is 100 basis points away from where it should be. The CPI inflation rate, which is actually almost identical these days to the PCED inflation rate, that's running around it's exactly at 3%, headline and core. Again, we expected 3%, but the markets decided that that was better than expected. And but again, we're 100 basis points above where we should be. So they're looking at the dual mandate and saying inflation, let's not worry about it, it'll come down. And here it is. This is the from the summary of economic projections that came out in September. Things couldn't have changed that much. So they're thinking that inflation is at 3.1% right now, or will end up the year at 3.1. They think that even if they lower the Fed funds rate, as they're anticipating, that the inflation rate will cool off to 2.6%, then 2.1%. So they say, look, we're still on track. And by the way, I don't really disagree with that. It's not clear to me that we need to lower interest rates. That might muck things up a little bit here. But I do think that the Trump tariffs did, in fact, boost inflation. And every official at the administration says, no, 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 there's been no impact on inflation whatsoever. You look at this chart, where's the tariffs? We're still kind of at 3%. Well, the tariffs are in the goods inflation. Durable goods inflation has gone up. And so my way of looking at it is 3% is where we are now. We would have been at 2% by now if it wasn't for the tariffs. I'm just being objective here, not subjective. I'm not being critical of our policymakers. I'm just saying it is what it is. So figure 10 is the Fed funds rate, and they think that they are going to have to lower it by the end of this year, further down to 3.4% next year, and then 3.1, and there's that Nirvana rate of 3%. Now let's talk about that Nirvana rate here. Let me go to this one. This is the dot plot, and you'll notice that the Nirvana rate of 3% is not some scientific number. It's not a math constant like pi, 3.14, etc. It's not that at all. It's just an average of 19 opinions of the FOMC participants. So we've got 6 of them that are actually below 3%. We got 9 of them that are above 3%, and 4 of them that are at 3%. So it's just, sticking your finger up in the air, see which way the wind blows. They each have their own opinion. They take an average and they say, well, 4% is restrictive relative to 3%. Not everybody agrees that it's all that restrictive, as you can see there. So we talked about the Fed funds rate. Let's move on here. I think we're at Nirvana. I think interest rates are consistent with Nirvana. I mean, you look at the unemployment rate minus full employment, let's make that 4%. We're only 0.3 above that. You look at the CPI inflation rate minus 2%, we're 1% above that and probably are heading down to 2%. So why aren't the current level of interest rates? Now, again, I don't really have a huge problem with them lowering interest rates, except I did respond by raising my odds of a melt-up scenario, which really is another way of saying that by lowering interest rates, they're not going to do much for the labor market. They don't need to do it to stimulate demand. It's already there. What they're doing is they're taking a chance of increasing financial instability, and that's something to be concerned about. On the inflation front, I'm not that concerned that we're going to have consumer price inflation accelerate because of all this, because unit labor cost inflation, as you can see, continues to be very moderate at 2.5%. So that's hourly compensation divided by productivity. In our roaring 2020 scenario, productivity continues to improve, so I'm not particularly worried about that. This is the latest CPI data. This is services. Seems to be kind of meandering just south of 4%. The non-durables seem to be kind of fluctuating, maybe around 1%. That's food and energy to a large extent. It's the durable goods inflation rate that's gone up from minus 4.2% as the low back here to 1.8% now. And that's where I get the idea that the inflation, overall inflation rate hasn't been boosted by the Trump tariffs, but it's been stuck there at 3% because if it hadn't been for the tariffs, we probably would have continued to see deflation in durable goods. You can look at the rest on your own. This is just another snapshot here of the services inflation rate. Seems to be getting a little sticky at 4%. And notice that's well above where we were prior to the pandemic. So we haven't exactly seen that come back down closer to 2.5%. And meanwhile, here's the goods reflecting durable goods going up. Rent inflation's come down, and even though rent inflation's come down, the so-called supercore inflation rate, services less rent of shelter, remains elevated at 3.7. I just want to quickly jump here to the quick takes that we put out on Saturday. You can see this is the market action year to date. This is what it's averaged over the past 10 years. Look, one could argue that the Santa Claus rally came early this year. Then again, maybe it makes more sense to argue that despite how great this bull market has been, this was a correction. It wasn't a bear market. So we're up quite a bit, 15%. We could be up another 4 percentage points if we get. We identify the Santa Claus rally as a November-December phenomenon. We don't say that it's Thanksgiving through New Year's or Thanksgiving through Christmas. You look at this and you get a 4 percentage increase on average over the past 10 years, and that would get us to 7,000, which happens to be our forecast. Momentum stocks, these are ETFs for momentum, up and away. Valuation is concerning. This is the Magnificent Seven at 30. This is the S&P 500 at 22, 23. The excluding the Mag 7, we're still kind of elevated at 20. We've argued that those are sustainable as long as we don't suddenly have some events that convince a lot of people that there's going to be a recession. So if there's a recession scare or an actual recession, then these valuation multiples will come down. And but again, we've had that happen over during the Roaring 2020s. We've had that a few times, and yet here we are at an all-time record high. And a lot of that's because forward earnings, all-time record high. Analyst expectations for 2026 are hanging in there really well at $305 a share. We're looking for $350 a share next year. So we think this is going to keep going up, and that'll continue to give the market a lot of support. This is the S&P 500 forward earnings. Still waiting to see some real signs of life in the SMID caps forward earnings. Even though their stocks are up, it's not being validated yet by those. Meanwhile, sentiment may be getting a little bit too bullish on the investors' intelligence measure. And meanwhile, for all the talk about how retail flows are coming in, you ask retail how they feel about things, and there's still more bears out there. Well, I'd rather go with the flows than with these surveys. These surveys just haven't been particularly useful. So with that, let's see if I can make myself useful here with some of the questions you've raised. Let's see. Could you comment the gold spot price that now is minus 3.4%? Yeah. Gold has been reacting to geopolitical developments. Recent geopolitical developments have calmed down. The Middle East has calmed down, at least for now. The Russia-Ukraine is still terrible, but the trade wars that that the United States has been in with other countries, they seem to be simmering down. Looks like we're going to get a deal with China in the next few days. Look, here's, I think, what's really going on, and that is the administration knows that the Supreme Court is about to take up the tariff issue and whether it's constitutional or not. I think they want to finish these deals, get them done, and come to agreements before the Supreme Court weighs in, because the Supreme Court may very well conclude that these tariffs are not are unconstitutional. Well, if Trump gets most of his major deals in place and that happens, then he's used the baseball bat. The baseball bat's been taken away from him, but meanwhile, he's accomplished a lot in terms of getting deals. So that's what I think is going on. And that's what's taking gold down. Look, gold went straight up from 3,000 to 4,000. That was 4,000 was our year-end target. We didn't change that. It's still 4,000. So that's kind of where we are. And we basically are seeing a 10% correction in gold. I've never been a big fan of gold as an asset because it's impossible to value. But I have been a big fan of it ever since central banks now seem to be buying gold, and Chinese investors seem to be buying gold because they got uh, annihilated in the property market and kind of beat up in the stock market. Oh, let me turn that off. I thought I turned it off, but anyways, you can always tell a robocall. I don't know how they do it, but they ring on my landline and then it rings at the same time on my cell phone. It's really very strange. Okay, let's go on here. William, not sure you're aware, but you're freezing up quite a bit this morning. Okay, sorry about that. I can't do much about that. I guess I'll have to check my just if one or two of you could just let me know if you had the freeze up problem as well, then I'll know whether I need to do something with my internet provider. Francis Hyatt, a lot of technologists anticipate radical reductions in employment because, let's see, no freeze. Okay, Michael says no freeze. Let's have one more. No issues. Okay, thank you. Now, so it's William. It's on your end. So Francis, any thoughts on positive labor market effects as AI deployment escalates? Right now, we're seeing a lot of the potential downside of AI in terms of job opportunities, and the technologists, as you point out, have been saying for a while here that people like Bill Gates and others have been saying that the way things are going, we may have to consider a basic universal income if AI, automation, robotics, humanoids, if they do everything we need to do in the goods production area, and if we have autonomous driving, and if a lot of services also get increasingly automated, then what are the rest of us going to do? Well, it'll be like we'll all be upper class Greeks and Romans. We'll have lots of leisure time to eat grapes and read and listen to books and paint and all that. But somebody's going to have to send us a check to support us. So there's talk. There has been talk by these technologists that at some point that may be the way we will have to consider. And in my 2018 book, I wrote about that as a possibility to the extent that I believed that technology, the future technology was becoming less and less in the future and more in the present. Okay. Do you think gold has peaked for a while or merely paused? I think it's going to consolidate. If you look at the charts we keep sending you, it just kind of tends to go up a lot and then kind of catch its breath for a while. So I wouldn't be surprised if we're still at 4,000 by the end of the year, and I'm still using 5,000 by the end of next year. But none of this comes with a money-back guarantee, of course. Chris, have the most recent earnings numbers about what you expected or any surprises? If the earnings and guidance look good, doesn't that support the market to continue to move up? Yeah, look, we have had a melt up, but it's been an earnings-led melt up. The PE has kind of been fluctuating where it's in a range, and the range has been like 18 to 22. Now we're at the upside of the range, but we had been at 22 a few months after the rally following the pandemic, the end of the lockdowns in the pandemic rally. If you go back to where we were about 6 months after the lockdowns, The forward PE was 22. The forward PE today is 22. And so from that point to now, the S&P 500 is up over 100%. And over that period, forward earnings are up 100%. So it's been a very solid bull market for sure. Okay, everybody's telling me no freeze. I'm not freezing. Well, that's good. I'm feeling pretty warm then. Well, thanks everybody. I feel warmed that I get such a good audience on a weekly basis from you folks. And let's do this again next week. See if we're having as much fun. Next week, I'll actually be doing this from a hotel room in Toronto. I'm going to be visiting my daughter in Toronto, some of our accounts in Toronto. If I missed inviting some of you, let me know, and I'll make sure you get invited to my events out there. But this was part of my Roaring 2020s tour. Taylor Swift did her Eras tour. I'm doing my 2020s tour. So hopefully I'll be doing this in a town near you over the next few months. Thank you very much.